Did you know 45% of the world's top 20 software companies are based in China? And that's why we should take note whenever the Chinese government is trying to influence, limit, or control these companies. Hi, I'm Farhan Rizvi, and today we're going to talk about the impact the Chinese government is having on the growth of these technology companies. So, what is the Chinese government trying to signal? Number one, they're signaling that they are the main stakeholder. Number two, they're able to do this because this is what they've done through state-owned companies in the past. Number three, they have varying degrees of influence in the economy through regulatory and economic pressure. And fourthly, the companies in question are all tech companies. Alipay / Alibaba Ant Group, Didi.com, JD.com, and Tencent. So the state has made it very clear on Monday that it will use all it can through its regulatory power and economic pressure when it comes to controlling these technology companies. The latest example is Alipay. Alipay is a super app of Alibaba. It does the loan processing and the credit distribution. The latest example is Alipay. Alipay is the payment processing arm of Ant Financial Group. You may recall Ant Group was the mega IPO of 2020, which was then delayed because of state interference. In addition, Alipay also houses the traditional payment processing that is used by Ant Group. Ant Financial Group is one of the largest online financial groups in China. Alipay not only does the payment processing, it also has the number crunching and the data analytics that is the heart of what Alipay does. Within Alipay, there are two big apps. There are two divisions, Haibo and Jiaibou. Haibo is the traditional credit card processing that needs to be done, and Jiaibou is the small unsecured loan business. Both these apps use extensive financial data that has been collected through Ant Group and its affiliates in determining the credit quality and the credit scoring that needs to be done. When these companies go IPO, there's significant money that's been invested in these companies. If you just look at the market capitalization of Tencent, it's about $600 billion. Alibaba is about $450 billion. JD.com is about $120 billion. And Didi.com is about $40 to $45 billion. That's significant money. So last year, when Ant Financial Group filed for an IPO, it was expected they would raise close to $30 billion. At that time, this would be a landmark IPO. The investment bankers working on it, they were salivating because of the large fees that they were going to get. Now, as part of the documentation, Ant Financial Group had to disclose its various profit lines, its various revenue lines. Alipay was the fastest growing profit driver in that documentation. 40% of revenues came from Alipay. The regulators and the government were taken aback. Close to 10% of mortgage lending is done through Alipay. Nobody was expecting that.
Trivia! What are the two credit groups in Alipay? Haibei and Jiaibei, Waibei and Kaibei, Zaibei and Jiaibei, or Zaibei and Kaibei? Answer: Haibei and Jiaibei.
So when these documents were filed for the IPO, the government officials were taken aback. There was a lot of surprise. And potentially this could be the reason for stopping of the IPO. Now, the first thing is that the Chinese government quickly needed to find a way to control these financial technology companies. And thirdly, there was a genuine concern. The regulators were genuinely concerned that if Alipay is processing up to 10% of non-mortgage lending, could there be a risk of concentration? So concentration risk as well as predatory pricing risk. In addition, the Chinese state and their regulators realized that not only is this a great way to control the revenue that these fintech companies are having, but you also need to control the data, the underlying data that has been collected by these fintech companies, which could later be monetized. And I think that is what led to the decision on Monday to break up Alipay. The first thing they did was to set up a consumer scoring system, a license. They've only allowed 3 state-owned companies to get licenses. This license will be required in the future to do any sort of credit scoring. In the past, these fintech companies had been able to use their own proprietary data and credit policies and to do the calculations using this proprietary data without doing this third-party state credit scoring. In the past, Ant Group has coveted such licenses. Why? Because this is almost a license to print money. When you use proprietary financial data that they've been able to collect on Chinese citizens, actually a very strong access to how, when, and how much credit these citizens will require. This is the final piece in the jigsaw puzzle in monetizing this data. So this summer, the Chinese central bank issued a directive. No credit scoring could be done using proprietary data. All of it had to flow through the 3 state-owned companies that had the license to do consumer credit scoring. So how is the Chinese state breaking up Alipay? First of all, they're spinning off the credit technology, which is both apps, Heibei and Jiebei, will be spun off completely as separate entity. The separate entity will be owned 35% by Ant Financial Group, 35% by a state-owned investor, in this case Zhejiang Tourism Board, and the rest small investors, public investors, or other corporations. Here, it's worth mentioning that the key sticking point of this week has been who will control, who will manage the new joint venture. As things stand today, it's going to be Jack Ma's management team, the same team that managed the credit technologies at Alipay. But will this stay? Who knows? Ultimately, I would think the state would want to control and manage the separate JV on their own. How they've been able to do for the other state-owned companies. The last thing which I want to talk about is really the most important thing, and that is who will control, use, and own the financial data that has been collected from the Chinese citizens. So in the new venture, Ant Group will not be allowed to use its proprietary data to calculate the credit scoring. The credit scoring will be done by the new JV, and they will not be allowed to use its proprietary data, which will actually have an impact on the margins of Ant Group financials. So in the future, an Ant Group customer will see that its credit application will be sent across to the new JV. Heibei and Jiebei will be doing their own credit calculations and number crunching to arrive at a credit score, and then they will then disperse this credit online through the separate company. And this way, I hope we have been able to illustrate that the Chinese government can use its regulatory power, its regulatory influence, i.e. the independent consumer credit scoring companies, as well as its economic pressure. The result of not using proprietary data would make sure that the economic profit of these fintech companies can be influenced as well. So this video was actually a very short explanation of how the Chinese state is influenced large technology companies based out of China. This by any means is not the end There'll be other companies affected. In fact, the next couple of weeks are going to be very critical for the global equity market as they try to understand what's happening over there. Please let me know if there are other companies you want me to dig deeper into. And if this video has been useful, please don't forget to share, like, subscribe, and hit the bell icon.